What's up, you guys? My name is Rick. Welcome back to the channel. In today's video, we have a lot to talk about. But first, we're going to get started with showing you guys my portfolio. Since you guys last saw me about a week ago, the market has been doing so-so, right? So I've lost about $60, which is 1%. And I've earned about $1.56 in dividends. So let's show you my activity feed. That way you guys get an idea of what we've made so far. So I actually forgot to show you guys my last video, my dividends for the month of September. So as you can see, I get paid every couple of days. Johnson & Johnson, Chevron, ExxonMobil, Microsoft, Target, 3M, Mainstream Capital, McDonald's, Realty Income, Duke Energy, Home Depot, Waste Management, and there's more coming this week coming up. So yeah, guys, so as you can see, this is what the dividends that I've earned so far. This month, I think it's been I've earned about $11 in just dividends. And guys, these $11 I did not put in. I did not put into this account. This account grows because of these dividends. Every dividend that I earn becomes one more soldier that gets put out into my portfolio to make me more money, guys. Compounding itself. That's why I like dividends. It might be small right now. I'm not getting as much, but you need to get the ball rolling. Your snowball rolling. You stop at the top of the hill, get it rolling slow, 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 slow. Then it gets bigger and bigger and bigger and bigger, and then it becomes a huge snowball that, like, at some point, I'm not even gonna have to put any money into this because it's gonna be growing itself. I could, but I wouldn't have to. There's a couple of people out in YouTube that have dividend portfolios of 200,000, 250,000. I know this guy. His name is Gen X Dividend Investor. He has a portfolio of like a little more than $1.5 million, and he generates about $50,000, $60,000 a year, not even have to do anything. So he can pretty much retire and live off his dividends if he really wanted to. He hasn't. I don't know why, but that's another story. Okay, so in today's video, we're going to be talking about the pros and cons about stocks versus an ETF. So we're going to get started with the pros of the stocks first. And number one is you have control over your investments, right? So you can buy a specific ETF, but you can't manage the allocation. For example, in my consumer pie, if we click on my consumer pie, I have control of what I put in my consumer pie. It acts like an ETF, but I am able to put the companies I want. For example, in this pie that I have here, I have Coca-Cola, Disney, Starbucks, McDonald's, Procter & Gamble, Home Depot, Target, PepsiCo, and I have two dividends that are not dividend stocks, but I still have them in there, which is Tesla and Amazon. Right? I don't have a lot invested in them, but that's what I have. Number two is your return potential. In some stocks, they grow at a more rapid rate. For example, let's say Disney, right? So for a long time after the pandemic hit, it was doing really poorly because it had to cut its dividend, and most recently it just spiked up to where it is now, and that's because you are heavily invested into this stock that it doesn't get devalued, or how can I say, it doesn't get demoted by other companies that are invested in the same ETF. Now, number three for investing in stocks is that you invest wherever you want, guys. You can invest in tech, consumer, finance, real estate, healthcare, telecom, industrials, utilities, in the energy sector, which I don't have, which is a topic for another video. But anyways, guys, so yeah, You can invest wherever you want, guys. You can set your allocation. As you can see, I have my allocation here to the right. You can invest wherever you want, and you can put a specific amount of money into every single one. And in that same pie, you can invest, do the same. For example, I have 30%. Now, that 30% of my money that goes into this account gets spread out into three different companies, and then I have a split of 45, 35, and 20. So that's what I'm talking about. You get to invest where you want. Now, number four would be your dividend payout schedule, right? So you can set your portfolio up to when you want to get paid, either monthly, quarterly, or a specific month. Some companies do pay out in September, some in October, November, December, etc., etc. Right? So you have control of when you get paid. ETFs usually only pay on a quarterly basis, right? So as you can see, I get paid in September, I get paid in August, July, pretty much every single month of the year, I'm getting paid, guys. Now, if you were investing in an ETF, you would either get paid only four times a year, which is a little depressing for me. Not, if you're investing into dividends and you're not receiving any dividends, I might as well just quit, honestly. Now, those are the pros of owning stocks. Now, here are the cons. The cons is number one is that it's very risky and you have limited exposure. Now I know there's some companies that are, how can I say it, very diversified. For example, Johnson and Johnson. But other than that, you're very you're heavily invested into these companies. Like, for example, in the financial sector, I have JP Morgan Chase. I have 35% allocated target allocation to JP Morgan Chase. I am fully invested these $291 just in JP Morgan Chase. If this company goes bankrupt, I lose my money. Now that's not a big possibility. JP Morgan Chase, um, the government likes to bail these companies out anyways. That's a video for some another time. Number two is the emotional roller coaster of owning a company, a stock, right? It's more specifically for someone new or someone that doesn't know what they're doing or what they got themselves into. If you do your research, you shouldn't have this problem, but it's still a roller coaster. Companies, stocks go up and down. As you can see right here, I was at about $6,200, and now I'm back down to about $5,900. So that explains this point. Number four, you think you have control, but you really don't. Each of these companies that you have that you're invested in, you're invested into them, but you don't have any specific control of what they do to them. For example, I own Apple. I have $727 invested in them. My return on them has been 31%, which is this is a money weighted return, by the way. If anybody was guessing, I've made $50 off of them. Now, I think I'm invested in them. I am invested in them, but I have no control what the company does. Tim Cook does, the CEO of this company. And that goes for any other company that I own here. For example, Bill Gates, which is not the CEO of this company, but he's one of the largest owners. That goes for any other company here that I own. Every single company that I own here has its own CEO. I might be investing into them, put my money into them. I might think I know what I'm doing. They have the control over everything. Now, number five, a con for stock investing is, honestly, it's one of the, some people like to do this. I don't really like to do this. Is researching every single company you have. So I've seen people. This is crazy. I've seen people who have over 100 positions in their portfolio, and I'm just thinking, like, do they even know what they're doing? Have they even researched every single company they have? Like, it's it blows my mind. Like, I have no. no words for this. Like that's why I like to keep my portfolio very small. And at 29 positions, I think I have a lot of companies. I would like to get this down to maybe 10, but it's if you want to be diversified, you can't really do that. You know, I might do 20, maybe in the future 25. But for now, it's sitting around 29 positions. So that's the pros and cons for owning a stock. Now let's get into the pros of owning ETFs, right? Now, as an ETF, as you can see, guys, I don't own ETFs. So the pros and cons of an ETF is the spread of the risk and where you want it. For example, there's a specific ETFs for most of these sectors, right? Now you can just choose them, and they're specifically allocated to certain companies, just how I have here. Like for example, I have this is my tech sector. I only have three, but these ETFs might have 30 different companies in the tech sector, which they allocate differently. You can spread the risk. Number two is you don't have to know what you're doing to get like awesome returns. For example, VOO, which is a dividend, Well, it does pay a dividend, but it's an ETF that tracks the S&P 500, right? The S&P 500 has, on average, has done around 7 to 8% per year. So you can pretty much double your money in about 10 years just by investing in this company, in this not company, in this ETF. So that's what I mean, guys. You don't have to know what you're doing to get good returns. Number three is that this is an ETF is truly passive income, because for that reason you don't specifically have the control to invest where you want. It is truly passive. You just pick an ETF and you invest in it. An ETF that has specific on a specific sector. Number four is that you won't lose your money because of how diversified the ETF is, because they have over 30 companies. Let's say a company goes bankrupt. Well, you lost some percentage of your money, but you didn't lose all of it. You still have 29 different other companies that are still in the S&P, in the ETF. Sorry. Now, another number five is that an ETF is managed. If a company doesn't perform, it gets replaced by another company. Like I mentioned in one of the points above, is that it's very passive and there is no research that comes along with it. Now let's get into the cons of owning an ETF. Is that number one is that you have less control over the allocation of your money or companies where you want to invest. You choose the ETF, but they choose the company and what percentage target allocation they want. Number two, it costs money, guys. It costs money to own an ETF, and it's called an expense ratio. To own specific stocks, I don't have to pay anything, but on an ETF, I do. Now, for example, VOO, which I have here, it has an expense ratio of 0.03. Now, that's very low, but it's still costing you something to own this ETF because it is managed, right? Now, number three, performance of the ETF comes from where it is allocated, right? For example, this VOO tracks the S&P 500. So if the S&P 500 does bad, guess what, guys? This ETF is gonna do bad. Now, number four, you can't really know when you're getting a dividend raise or not, right, guys? So on specific companies like that I have here, um, I can uh, I can predict where some companies are going to make dividend raises. For example, Microsoft just did a raise a couple of days ago, which is I think 0.2%. Not quite really sure. Don't quote me on this. But last around this same time last year, they did one as well. So that's what I mean when you can kind of tell when you're getting a dividend raise. Now, for myself, I don't hold any ETFs, as you can see in my holdings. I don't hold any ETFs because I think I'm doing a better job just holding these companies and paying someone else for an expense ratio to do this for me, right? Now, I've created an ETF of my own, if you want to say that, right? Because of how M1 Finance is made. It lets you allocate specific stuff to the specific sector you want. Alright guys, so that is it for today's video. Guys, please consider subscribing, and if you liked the video, please like the video and share this video with your friends. Remember guys, I want to help everyone invest for their future. Peace.